One of our stocks doubled in a few months. That created a problem. When a winner grows too fast, it can swell into a third of your account, and one stock should never decide your whole retirement. Today, I'll show you exactly how we decide which winners to trim and which ones we let run. If we haven't met, I'm Berk's AI avatar. I deliver financial content for free so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Here's the plan. First, how we size every position. Then, the two prices that guide us, the buy below price and the sell above price. Then, what we actually do when a stock breaks through one of them, using a real example with AMD. A client told me last month he had let one stock grow into a third of his savings. It felt great on the way up and awful on the way down. Sizing is how we stop one stock from running the show. Every stock we love gets about the same amount of money, 6 cents out of every dollar. In plain terms, one full position is 6% of the portfolio. We aim for 10 of these core positions. 10 times 6 is 60, so about 60 cents of every dollar sits in our 10 best ideas. Here is the simple math. If those 10 rise 30%, that adds about 18% to the whole portfolio. 60% of the money growing 30% is 18%. The other 40 cents moves around up or down maybe 8%. If the gains and losses cancel out, that piece adds zero, and we still reach our 18%. Why aim for 18%? At 18% a year, money doubles about every 4 years. 72 divided by 18 is 4. Our goal is to double every 3 to 5 years, the same as owning businesses whose real worth grows 15 to 25% a year. Real worth is what a company is truly worth based on the cash it produces. We call that intrinsic value. Two prices keep us honest on every holding. The first is the buy below price. That is the highest price we are willing to pay for a great business. At or under it, the stock is cheap enough to own, so we build the position up to that 6% size. We call the amount we put in the cost basis. The second is the sell above price. That is the price where the stock has gotten too expensive to keep. Above it, we are no longer being paid for the risk we are taking. The buy below price tells us when to step in. The sell above price tells us when to step back. So, what happens when a stock breaks through one of those prices? A breach is just a fancy word for crossing the line. A client asked me why we would ever trim a winner. AMD is the answer. We owned AMD at a 6% position. It ran up fast to about 12% of the portfolio and crossed our sell above price. The rule said sell. Before we did, we rechecked our work. Our valuation model was still using older numbers from an earlier period, so the sell above price was stale. Instead of selling the whole thing, we trimmed AMD back to a normal 6% position and kept watching. Soon after, the price dropped back below the sell above line, and the stock has climbed again since. That is the real lesson. The sell above price is not an autopilot. It is a trigger to go recheck the work before we act. Quick break for the serious investors watching. If you want the free guide that lays out this whole process on paper, the link is in the description. No cost, no pitch. Now, the three choices. If the work still says the business is cheap and growing, we let it run. If a winner simply grew too large, like AMD, we trim it back to 6% and hold the rest. And when a stock truly clears its sell above price and the work confirms it, we sell the whole position and move that money into a cheaper, high quality business, building it up to a 6% cost basis. After trimming AMD, we moved money into names like Microsoft, Accenture, Roper, and Novo Nordisk. A couple of those, Microsoft and Accenture, we also own quality like IPAR, which just broke out, and healthcare leaders Eli Lilly, Novo Nordisk, and Merck, which have broken out too. Everyone earns a strong, durable return on the money it puts to work. That is the whole process. Size every position at 6%. Use a buy below price to know when to step in and a sell above price to know when to step back. When a price breaks, recheck the work before you act. Let winners run while the business stays cheap and strong. Trim the ones that grew too big and sell outright only when the work says the price has run past the value. If you want my team to look at how your own portfolio is sized, the link to book a quick call is right there. Watch this one next, where I walk through our weekly market review and show you the portfolio in action.